Now, Wayne Wilbanks is Chief Investment Officer at Wilbanks Smith and Thomas Asset Management, where they manage $1.2 billion. He is cautious about the markets and joins us now to discuss what he thinks the 5 big themes are that will weigh on the U.S. over the next 5 years. And thanks for coming on the show, Wayne. You think we're basically kind of range-bound this year, maybe go down to 875, back up to 1,000 before the end of the year, but longer term, the outlook isn't so great.
Well, we think there's a number of trends going on in the market right now, and those trends include the consumer starting to save, and you saw that in May. The consumer is saving 6 to 7% of his income, and that's going to take a huge chunk out of the economy over the long term. Plus, the government is increasing their debt at pretty historic rates right now.
Well, and do you expect the consumer to save more? I mean, we've heard comments from Nouriel Roubini that if the consumer goes up to 10%, in a relatively short amount of time, that could be very bad for the economy.
Right. His point is key. The timing of it is what's important. It's okay to be at 7, 8, 9% savings rate, but when you go from 0 to 9 or 10 over a period of a year, there's a huge vacuum in the economy, and that's what the government's trying to fill right now with the stimulus.
So, and the government has obviously a lot of other things on its plate as well. We just heard the president talking about health care, and a lot of people have said this is going to be a serious addition to U.S. government debt. How do you see it?
Well, we're at 75% debt to the GDP ratio with the government right now. Japan's at 175%. So there's room here for us to increase our debt to take care of some of these issues, but it's something that investors need to keep a close eye on because the government, by the end of next year, is going to be finished with the stimulus.
Well, and you saw, a downgrade for the UK when they got to 85%, right? So
absolutely.
Even if there's room to grow, it's still a relatively scary number.
Right. I mean, these are big numbers, and investors, global investors, will walk away from the currency. Not yet on the U.S., obviously, because we're the #1 currency, but it can happen, and we've seen that in Britain.
Well, and there's been a lot more talk about it, right? I mean, a couple months ago, it was a laughable topic. The U.S. dollar obviously is going to remain the world reserve currency. Now people have started seriously discussing it, including at BRIC Nation conventions, including at the G8. It's been a more... Do you think we're going to see more diversification from the big holder of U.S. reserves?
In the short run, it's very, very difficult to part $2 trillion if you're China in the euro, in the Japanese yen. So I think we're okay for the next 2 or 3 years, but they're going to watch what we're doing, and they're creating these special drawing rights right now as an alternative for them to look at.
Well, so it'll definitely be one of the 5 themes. Emerging markets is interesting because we have a top story today pointing out that they've gotten relatively expensive. We're looking at 15.4 times reported earnings for the MSCI. That's more expensive now than the S&P. Do you still have faith that there's room to grow there?
Absolutely. This is a 10-year call on our behalf. We think right now we're at 10% exposure to emerging. We could foresee that we'd be 20 or 25% of our equity portfolios in emerging in the next year or two. The growth rates people are looking at right now for the next 5 or 7 years so dwarf what's going to be going on in the developed world that people, I don't think 15 times, I'll pay 20 times for that market if I can have the kind of growth rates that we're going to be looking at that are almost unchangeable without a major global turmoil event. So this is a long cycle play that you've seen some of these guys that have moved to China. We've certainly seen Jimmy Rogers moved his whole family over there.
We've seen a lot of people go to Asia. That continues.
Yeah, exactly. So this is not an overnight. Maybe in the near term the PEs are high, but long term
it's a long-term trend.
Absolutely.
All right, Wayne, listen, we're going to take a quick break here. We'll come back and talk about 4 and 5. Don't bring the board up again. It'll be a surprise when we get back. Wayne Wilbanks, when we come back in just 2 minutes, stay with us here on Bloomberg. All right, we are back with Wayne Wilbanks, Chief Investment Officer at Wilbanks Smith and Thomas Asset Management. Now, we're talking about the 5 themes that you think will weigh on U.S. markets over the next 5 years, really 5 to 10 years. And it's interesting that you don't get a lot of really long-term outlooks these days.
Right. Well, it's an education process for us with our clients as we begin to think about, well, the past 10 years, U.S. equities have done a 0% rate of return. We're not saying abandon U.S. equities by any stretch of the imagination, but within that diversified portfolio, investors are going to have to think outside the box. They're going to have to look at some of these other areas.
Let's talk about, we covered the consumer savings, government debt, emerging markets. Obviously, you could talk about all these things for hours. Climate change is something we've been talking about for years. You're saying it's a real serious problem going forward.
Right, and we can debate how carbon is accumulating in the atmosphere, but what we're seeing from the scientists is it's actually worse than what people think right now. And so we think areas such as the clean areas, solar, wind, there's a number of these areas that are going to be emerging, and companies that are building out the infrastructure for the new transmission lines. All of this area is going to be an area which we think is very, very positive.
Well, and the fact is, it doesn't really matter if it's truly going to be worse or not, right? It's the perception that matters, because as long as governments think it's going to get worse and pump money into it, then that's where you
right. I mean, we can debate on why the Earth is warming, but the Earth is warming, and that will have key measures in a number of different areas. But, you know, clearly the ball is rolling now with the government spending a tremendous amount of money. Most of that has not been spent yet. And so we see that being spent over the next 18 months.
Let's talk about the population boom, because this is a problem that we've been, I mean, Bad Religion wrote a song about this, 10 in 2010, back in the early 90s. We haven't gotten there yet. 10 billion people. Are we really going to see this explosion that we've been warned about for so many years?
Absolutely. You look at the math, and it's not the U.S., it's not China, it's Africa, it's India. These are countries that will increase their population at pretty geometric rates, and there's really nothing we can do to stop it. So the world at 6 billion on its way to 8.5 or 9 billion people does a lot of things for commodities, for food supply. So there are a number of areas. In our case, we're very bullish on commodities.
Although 8.5 by 2045 is a much less serious prediction than 10 billion next year, right? I mean,
right.
It's not going to be the kind of scary forecast that we'd heard about back in the early 90s, late 80s.
Right, but if you do the math and you look at the way that we spend our monies and we supply ourselves, if the Chinese and the Indians decide they want to have a middle class, just like the United States, there's not enough eggs, there's not enough wheat, there's not enough copper to fulfill that, you know, their desires.
Well,
and so we're going to have to plan ahead for that.
We're already seeing a rally in soy because they want so much more pork in China. We're going to talk about that later with our commodities reporter, Michael Whitney. Let's touch quickly, though, while you're here on financials, because obviously there's been a lot of action today in financials. This week, we're going to get earnings. We were talking during the break. You think, for example, Bank of America is cheap at $12.
Right. What we're hearing from our Rolodex, from talking to executives, is the banks are making a tremendous amount of money right now. Their cost of funds has dropped almost to zero. The bank fees, the charges, the floors. We're hearing horror stories where the large banks are extracting huge sums of money out of their out of their lenders. And so in this case, what you're going to see is we think the earnings will surprise people next year. And obviously next year, the write-offs are not going to be nearly as bad as they are right now. So you take Bank of America with a $25 book value, could earn $40–50 billion pre-write-offs. That's tremendous for a stock with a market cap of $75 billion.
How much do we worry about the non-performing assets? I mean, the toxic assets were the big fear, and it looks like everyone's gotten pretty sanguine on them.
Well, we think the housing side of it is almost under control. Where we think there obviously still issues is commercial. Commercial is going to be a disaster over the next 6 to 9 months. But when you're setting aside, in the case of Bank of America, $6, $7, $8 billion a quarter of write-offs, you're reserving, in other words, you're washing out a lot of the bad news. And so what happens when you drop to $4 billion of write-offs from $8 billion, all of a sudden it all goes to the bottom line. And their core businesses, for the big guys, are doing very, very well.
All right, hey, Wayne, thanks so much for coming on today
and
sticking with us. Wayne Wilbanks there from Wilbanks, Smith and